How's it going, folks? Markets are still looking very heavy indeed, but we do have some developments on the situation in the US, particularly regarding employment data. So we're going to get into that in just a second because it relates to how I see this playing out. But first of all, of course, we're going to start with Bitcoin pricing because we are currently trading at a price of $91,800. And you can see, once again, we bottomed out sub $90,000, 89,131. We've reversed some of the gains made into the end of yesterday over the last couple of hours, and the market just looks plain heavy. Okay, classic downtrend really since the 25th, but as we know, this has been playing out for a lot longer than that. One thing I do want to draw your attention to is if we look at this on the daily time frame, we can kind of contextualize even what some of these drops look like. Basically, what I want to point out is the fact that it is not quite so scary in the broader context of things. Okay, we've had two similar looking drops over the course of this bull market that in terms of percentage loss haven't really equated to the same kind of thing. So if I just get this finally onto the daily chart for you, you can see that if we reconcile the data in terms of percentages, right, from the all-time high to where we're trading right now, that represents a loss of about 28%. If we take a look at the former all-time high from January 2025 down to the lows, we see about 31.62%, okay, larger. And then even if we look back towards March 2024, right, this sell-off took us down as low as 33.68%. So we're still not there yet. Obviously, we have smashed through the 50-week moving average this time, which isn't great. But nonetheless, important to remember that in percentage terms, we're not yet at the point where this is looking completely uncharacteristic for the bull run, at least for this bull run. So you can see we are looking at the US economy shedding 2,500 private sector roles in the weeks ending November the 1st. So this is ADP's moving average data point. What you're looking at here is basically a contrast to their main data release for October, which actually suggested adding of 42,000 jobs overall, right? This is the moving data point. So there's a slight nuance in there, but essentially that still points towards losses in the private sector towards the end of the month. And that does reconcile with what we've seen with the likes of Target, for example, cutting about 1,800 corporate jobs. But this is, of course, private data, right? ADP is one of the private data sources that the Fed uses in lieu of, or used in lieu of the Bureau of Labor Statistics, right? They were relying much more heavily on this private data about the labor market so that they can make decisions on monetary policy like rate cuts, for example. But the way this has gone down is quite interesting. Okay, so obviously that data point in isolation is better than the last one, right? But it's still not looking great, right? It's still negative. And this plays into the odds of that rate cut at the December meeting, right? Which has increased now from about 43% or 44% yesterday up to about 50%. So we're right back at the coin toss scenario. We have got Fed's Waller talking about the further justifications for a rate cut in December. Some of this is quite concerning if you're thinking about this long term, because he does actually mention the R word, right? Recession. This is a member of the Fed speaking about recessionary risk, which is somewhat concerning. But of course, that rate cut at the December meeting is likely going to play into where we see risk assets going moving forward. So Waller urges the Fed to consider job market risks. Waller estimates inflation excluding tariffs near Fed's target. Fed's internal divide on rate cuts could affect policy expectations. US firms have begun talking more frequently about layoffs, right? We just mentioned Target, as they plan for weaker demand and possible productivity gains from artificial intelligence, Federal Reserve Governor Christopher Waller said in remarks that continue to build the case for further rate cuts amid a broad policy dispute at the US central bank. If you actually take a look at this take here from Yahoo Finance, you can see this recessionary risk warning that Waller's making, right? A senior Federal Reserve official has warned of a possible US recession after eye-popping layoffs from major companies amid a slump in consumer confidence. Christopher Waller, a member of the Federal Reserve Board of Governors, said he would vote for an interest rate cut at the central bank's next meeting in December because of clear signs that the US economy was significantly slowing compared to last year. Yes, we've got conflicting data. Some of it's looking slightly better than it was potentially. Okay, this ADP data that we just spoke about is no doubt a green shoot, perhaps, right? It's slightly less negative than last time we checked. It's still not looking incredibly good. It's basically looking at a sort of stalling in the labor market, pointing towards recessionary risk, but also bringing us more likely to continued rate cutting from the Fed. So all of that's quite a lot to digest, but basically, once again, unfortunately, we're still waiting to see what the official data looks like. It's looking like October's data release is going to be redacted. We're going to be missing a key part of that. This was the part of the data that wasn't able to be collected during the government shutdown. We're also missing September, and then we're also going to get official data for November as well upcoming. But that first data point is going to be released on Thursday this week, and I think markets are very much braced ahead of that. So bringing it back to crypto and to Bitcoin, of course, we can argue about whether or not investors see Bitcoin as a recessionary hedge or not. We have got more voices other than myself calling for buying the dip opportunities, or at least averaging into the dip opportunities. I do believe, by the way, that some sort of relief bounce is imminent. Of course, pending data that we see, the first of which will start coming out on Thursday, and that'll start giving us a clearer picture, I think, of where things are going, at least in terms of attitude towards risk assets. But we've got Gemini's Cameron Winklevoss flagging Bitcoin's sub 90k level as a rare buying opportunity, which I do think there may well be some truth in. Gemini co-founder Cameron Winklevoss told investors Tuesday that he believes Bitcoin under 90k may be a last chance to buy, as the token slipped below that level, erased its 2025 gains, and reignited debate about the cycle. And the truth is, right, the way I rationalize this, okay, the truth is that may very well be true. It may also very well be wrong. But the way that you hedge yourself against that is simply by dollar cost averaging in. If you believe in this thing long term, then the only sensible solution, the one that has proved to pay off time and again long term, is not to over allocate yourself at any one particular point. It's just to keep dripping money into the market over time, money that you can afford to lose. And then you're basically giving yourself advantage of time in the market versus timing the market. But in terms of looking for an obvious massive bounce right now, I am coming up pretty short, to be honest, on that, in terms of where I could actually see this turning around with any particular degree of certainty. The only thing going for this really, in my mind, is a lot of pessimism right now. Okay, sentiment is down even lower than yesterday by a point. I believe we were at 17 on the Fear and Greed Index yesterday, today at 16. We do still have a fair amount of short leverage liquidation risk above us, and we've been moving one direction for so long, preceding some upcoming data releases. I think it's fairly likely, okay, if we can take anything from the ADP jobs data that we just looked at, that we might see a somewhat brightening picture on there. It's probably not going to look incredible, but potentially somewhat brightening. Possibly that would be reflected in the official data too, although we've got lag on that, of course. But we've also got this return on the needle towards a rate cutting situation. But either way, like, the bigger problem here that I see is deeper concerns about the US labor market. But if we see some of that clearing up, and if we see even a small turnaround in risk assets as a whole, i.e. equities, I think it's likely some of that is reflected in crypto. We find some bids, and then we've still got, although open interest has reduced overall, still a fair amount of short liquidation risk to the upside. So any turnaround in this, particularly while sentiment is so low, could very well fan the flames for the opposite effect. But in any case, just my opinion, just what I'm looking at right now. Of course, none of that should be considered financial advice, purely shared for entertainment purposes. But thank you so much for watching. Plenty more to come. Catch you in the next one. Bye.